This video is about equity contributions in a project finance transaction. Okay, so let's go and look at the definition of project finance. Project finance, as it is written in the books, is the funding of long-term infrastructure, industrial projects, and public services using a non-recourse or limited recourse financial structure. So the next question is, so does that mean that the sponsors, they do not have to bring anything into the project since it is non-recourse or limited recourse? Not at all. Sponsors and shareholders are still required, especially by lenders, to have what they call some skin in the game. They need to make sure to provide the support. It can be financial, it can be technical, to make sure that the project is successful. Okay? So this is what I want to discuss today about what are the contribution, what are the different types and form of, so these are the topics. I will take you through the different type and form of equity contributions, the amount of equity contribution and timing of equity contribution. So quickly, in terms of the type and form of equity contribution, there are mainly two types. One is the base equity and the other one is standby equity. Base equity is basically what is required from the sponsors in terms of the financial contribution to fund the construction. Okay, so the famous sources and uses of funds table. So the sponsors are required to fund a percentage of total project cost during construction. And also, they are required by lender to provide some kind of guarantee or some kind of support in terms of cost overrun. And that facility is called standby equity, which is supposed to fund any cost overrun. When it comes to base equity, then we have basically two types of base equity contribution. It can be in terms of pure equity, which are just shares in the SPV, in the project company, or it can be a long-term loan, which is a shareholder loan. So from the point of view of lenders, because we always look at lenders and sponsor, from the point of view of lenders, they will not have much say in terms of the form of base equity contribution, these pure equity and shareholder loan. Of course, they want to understand it, and they want to have access to the joint shareholder agreements. However, this is basically the sponsor's own internal kitchen, how they want to structure their pure equity commitment, whether it's shareholder loan or whether it's sponsor pure equity or a combination of the two. And the decision is mainly based on, the jurisdiction of a country, because interest on shareholder loan can be deductible. So that can be a benefit that the shareholder might want to consider in their equity contribution. And in general, it is much easier to extract cash in form of shareholder loan because of the accounting restriction. So you can bypass the accounting restriction and extract cash, especially in the early years. So that's the different type of equity contribution. When it comes to the amount of equity contribution, we need to discuss the base equity different than the standby equity. When it comes to base equity, there is normally, a maximum gearing, the maximum debt to equity, which is going to limit the total amount of debt that can be raised. So typically in project finance, it can range between 70, 30, 80, 20, depends on the risk, depends on the type of project. For mining, for example, 50 many percent debts is only 50% is required. Other projects, renewable power, it can go up to 75%, even 80% in some cases. When it comes to standby equity as well, there is always a maximum ceiling. We cannot just leave it open-ended. There is always, in the loan agreement, there is a clause that says that the lenders require the sponsors to provide a standby equity for the X amount that needs to be contributed in the case of any cost overruns. Now, the last point is regarding the timing of equity contribution. For base equity, there are different type or different drawdown schedules that can be acceptable by lenders, and it's always subject to negotiation. The first one is 100% equity contribution upfront. So this is basically what the lenders is the preference from the lenders, because sponsors are going to put all their money upfront, so they have more at risk, in the beginning of construction. They have put all their money upfront, so they have more skin in the game. Again, that same expression. The other one is the other extreme. We can go too extreme. The other extreme, that the third one is what sponsors mainly prefer, is to have their equity come last. Okay, but because it is not really realistic, so we consider an upfront equity, a percentage upfront, but then the remaining coming last after the drawdown on all other facilities are done. So the remaining will be contributed by equity towards the end of the construction. So this is the sponsor's preference, and usually it's the middle one that is applied, which is an upfront equity and the remaining pro rata during construction debt and equity. So at each drawdown, at each utilization request, there is a pro rata equity and debt drawdown. So this is for base equity. For standby equity, also there are two options that I have seen in the transaction. One is that the sponsors, or the lenders rather, require the sponsor to basically contribute to any cost overrun as soon as it occurs. Okay, so at each utilization request, they compare the actuals versus the budget, and if there are any cost overrun, they ask the sponsor to fund, those cost overruns. And the other one, which is the more common one, is that lenders, they accept that, okay, once we have finished drawing down or utilizing all the facilities, base facilities, meaning base debt and base equity, then we can tap into the standby equity. So I will show you these ones in a financial model as well. Okay, now let's go and look at a typical project finance model, and I'm going to take you through the things that I want to see when it comes to equity contribution. So in this model, I am on the base case now. So I am drawing down on my facilities, senior facilities. 70% is coming from senior debt, and 30% is coming from base equity. And I have activated a tranche of pure equity and also a tranche of shareholder loan. And all of these are defined in the input sheet. And since I am in the base case, my standby equity is 0, because I only trigger the standby equity when I am doing sensitivities, and I want to see whether the standby equity can cover any potential cost overruns. So if I go to my input sheet, I have, the possibility to size my base facilities using different methods. The first method is the debt to capital ratio. So I will have what you saw in the summary sheet: 70% debt, 30% equity. Another option is the minimum DSCR. And I can also use the minimum of the two. And when it comes to sensitivity cases, for example, when I increase my capex and I increase the interest rate, I need to first fix the base facilities so that I can see the impact of sensitivities. Basically, I need to put the model in the situation that I have signed. I am at financial close. I have signed all the loan agreement, all the shareholder agreement. So the lenders, they have committed to a maximum debt amount, and the sponsors, they have went to their board, both sponsors and lenders. They got a signature from the board members for a maximum commitment. So we cannot change the maximum facilities anymore. Now we want to see what's going to happen if I have a 10% increase in my capex. Now I want to see what's going to happen if I have a 1% increase in my interest rate. And what's going to happen if I have a delay in my construction. So I will do that all by fixing the base facility sizes. When it comes to shareholder loan, whether the option of, having a shareholder loan and pure equity, I do that by using a single parameter. 55% now is shareholder loan, and the remaining is coming, in the form of pure equity. And of course, when it comes to the standby equity, I introduce a maximum amount so that I don't go beyond the maximum amount. So during structuring, I might still have the flexibility to size even the standby equity, but at some point, this is also going to be hard-coded in the model, and that's what I have done here. I have put the maximum amount, I have introduced it in my input sheet. Now, when it comes to the timing of equity contribution, I want to have the option to, as I told you earlier, I want to have the option to either introduce 100% equity contribution. This is, as we said, is the extreme case. Let me run the macro because it might take time. So this is the extreme case where the lenders, they say we want all 100% equity to be contributed upfront. Of course, the impact of having, 100% upfront or, pro rata is, it depends on the duration of construction. If, for example, you have a 1 year, you have a solar project with a 1-year construction, it might not impact, the return to equity with whether you put 100% upfront or you put 100% down towards the end of construction. It will not have much impact. But when you're working on a hydro project, for example, which takes sometimes 3 to 5 years to build, then it makes a significant impact whether you put your equity first or you put it last or you put pro rata. So now this is the case where I put 100% my equity upfront. As you can see here, this is my line of total project cost, on monthly basis. So month 1, I require all the 100% of the equity to be drawn, and then they don't have anything to contribute anymore since they have put their maximum upfront. And then from then on is the lenders which will have to catch up and fund all the remaining construction cost. And then I also want to have the option to have zero upfront contribution, zero upfront contribution. So as you can see here, debt and equity, all of them are basically coming pro rata. So in each construction month, I have 30% coming from equity, 70% coming from lenders. And this is shown in this gearing ratio that I am calculating here, which is 70% throughout the construction phase. And as I explained to you earlier, most of the time, what is negotiated is to have an upfront equity requirement from the sponsors, and then remaining to be drawn pro rata with debt and equity. And as I said, the impact on IRR depends on the duration of your construction phase. So let's hope that this finishes, and then I continue. with the sensitivity case. Very good. So this is done. Now, let's see again. Let's go to our sources and uses. You see that here, because I am still in the structuring, I am not triggering, the standby equity instrument. However, if I want to see the impact of the standby equity, I need to first of all fix the debt and equity, the base. And now I will come and I will apply a sensitivity. Let's say I increase my interest rate by 2%. Okay, let's see what's going to happen now in my funding package, in my sources and uses of funds. So I have fixed the debt and I have fixed the equity amount. So any cost overrun, which in this case is due to the increase in interest rate, which can happen if you don't fix the interest rate during construction, it needs to be funded from the standby equity. So as you can see here now, I have a 6.7 million that is coming from standby equity. And the way I modeled it is that I'm going to first draw down on all my base facilities, and then whatever I cannot fund remaining, I'm going to fund it now with this standby equity instrument. So just, I'm not going to take you through the mechanics. I just wanted to show you the flexibilities that you want to have in your financial models when it comes to equity contribution. So that's it for me, and hope to see you next time.